Rich,
Thank you.
Staying on the blue dot.
Good to be here, and based on our experience, I'm the one that suggested First Associates and Millennium were making all the money in this industry. So. But at any rate, and we're just peanuts. But at any rate, I really appreciate you all coming. I really appreciate our partners supporting this function every so often and having us together and get together and network. So appreciate that, and thank you all for coming out on our first day of rain this year. I'm going to make it really quick because I'm just going to run through how I got caught up in this industry 4 years ago, and then what we do at Emerald Direct Lending, and then what I see in the future here for the industry. But first of all, as we look at, I ended up retiring from Brandis for the third time. I was at a large bank, retired there when Bank of America bought us, and then I went down here. I did some restructuring work and startups, corporate finance work for several single-family offices, retired again, went to work for Brandis. And so I was really done with it about 4 years ago when I retired from Brandis, and I had a good friend introduce me to two guys launching a new fund up in Oceanside, and it was going to be in marketplace lending, which I didn't know anything about. I didn't know much about consumer lending. I'd always been in the wholesale side of the bank and in the trading world. So this was kind of interesting to start to follow it. So I met with them a couple of times, and because my background was primarily institutional, they wanted me to start soliciting institutional investors. Well, it took me about 2 months to figure out that this little fund launching was not going to find a lot of institutional investors. And so we agreed we'd go out and raise some capital, or we'd find an investor that was a large money manager that had the back office, had the ability to handle our business. So as we launched and grew it. And we ran in at a conference an institutional conference in Huntington Beach, ran into the CEO from Emerald, who was, I think, suffering hangovers that morning because he hadn't won the Manager of the Year award that had been handed out the night before. And I saw him sitting at the table by himself, went over to talk to him. He says, you know, that's funny. I just left my room, watched a television program where this French-speaking fellow was talking about a company called Lending Club. And then I sat in the first session of this thing, and it was another fellow from direct lending talking about this marketplace lending. He says, what's it all about? And I said, well, it happened to be I'm involved in that, and my partner's over here, and that's the guy who was speaking, and you ought to come meet him. Well, short story, a month and a half later, they bought this firm and launched us. And they were a large equity manager, had no experience in the lending business. They did have a fixed income book, but they started to oversee what we were doing, and took them about 6 months to really get very comfortable. And we've grown very slowly with what we're doing, but we now have 3 funds under management that does only consumer loans, and we buy off the major platforms. And the first fund we launched 4 years ago, so we have a 4-year track record on that fund, and it's primarily an all unsecured consumer loans, 3 and 5 year off the platforms. The second fund we launched just last year, which we added leverage to it, and so we've only got 1 year experience with that fund, but again, buying the similar kind of unsecured debt, taking a little bit more risk in that portfolio, but balancing it, the lower risk with some higher credit, so we kind of left the middle of the market of credit extension open and not been involved where Fund 1 was more involved in the center part, higher yields and greater defaults. This has kind of it's almost like a barbell. And so that fund was launched, added the leverage, and they're doing very well with the returns on that with the leverage added. And then the third fund we launched, which I think is extremely exciting and fits more into my background, the institutional side, was an Emerald managed yield plus fund, only for pension plans. But the pension plans have been able to add this as an alternative to their pure short duration cash portfolio or near cash alternatives. So that's basically treasuries, high risk corporates. And by adding 5 or 10% of this type of structure to their portfolio or that allocation, and we had to use a CIT so that they have a security listing on the exposure that they have so they can list it with all their other securities they're holding in their short duration portfolio. And that has been very successful, primarily only sold in Pennsylvania right now to the state, city, and county pension plans and Taft-Hartley funds. So those are the 3 funds we're running. The things I've learned from being in this, were a couple of things I talk about. I know banks are so caught up with all the problems, regulations, settlements that they're doing, they're not involved. But my experience in banking, having been on the entrepreneurial side of banking, launching new companies and new businesses all over the world, I do see them looking at this all the time. And you've seen Citi and Goldman Sachs and Wells Fargo all nibbling in and around the edges. But I think that's a business because of their low cost to access borrowers and their low cost to access capital. They can be a major player if they ever want to be in and they ever get all their litigation and settlements done. But the other part that I find most interesting, and I was the chief risk manager on the wholesale side of the bank for Security Pacific, is the credit risk assessment. And we got involved in this business and we were looking at the credit risk. We used actually to start out using the data and statistics of the Federal Reserve and studies back 30, 40 years and came up with our ideas of the kind of loans we ought to be buying, the kind of interest rates we could make, the kind of default rates we'd experience. And as we got through it, working the first couple of years, it didn't prove out that way. It looked really good, but then as we got into about the second or third year of the fund operation, we started to see defaults coming in and being significantly above what our analysis had told us in the initial stages. So we went back and looked at it, and I think Peter Renton had one of the most interesting articles in 2015 where he came out and outlined the 5 or 6 different risks that he saw in this marketplace lending. And that was the first time it really opened my eyes. And he got talking, the biggest one was kind of the difference between the platforms and we as investors going on those platforms and buying loans. And in that case, the platforms are driven more for developing loan volume while we need maintenance of quality of the loans. And that diversity or that divergence causes a conflict somewhat. And it was part of driven by lower interest rates being applied in those earlier years for the same credit. We started to sense that and look at that. You had the heavy amounts of prepayments and that again affected all our models. And that the final one was that really marketplace lending, unsecured installment loans, was not the same as credit card debt. And that kind of hit me right between the eyes. And I said, this is the reason why we're struggling, is we've kind of used all the data that morphed off from installment loans at the bank to credit card debt. And therefore, we were really looking at some of the wrong statistics and data. Once we figured that out, we've really adjusted things and now working harder to get the yields back up to our objective around 8% for that Fund 1. But it really was an eye-opener to me, and I think that's probably one of the risks that have to be assessed. This industry is wrought with a lot of risks that have to be assessed. I think 25 pages of our PPM out of 50 addresses different risks that we have to face, and we have to manage that. And we do it through diversification, and mostly portfolio diversification, and high-tech use of data and information to do a better job. But those are things we continue to have to improve and work on to really generate the returns we want. And although I've talked a lot about some of the negatives and that, we're very positive on this industry. We've grown very slowly. It's been disappointing, I think, from my standpoint, because when I first saw this, I thought we'd go through the roof with these funds. But we've grown slowly. We've done our due diligence on everything. We've had a lot of outside third-party advisors to help us structure what we're doing, structure these 3 funds. But our CEO thinks this is the most exciting business that he has seen come down the pipeline in 20, 30 years now. And he runs 2 of the major small cap growth funds in the country on the equity side. So fitting this in was extremely exciting to him to have this as a product. And now we're off and running with it. He thinks, and comments on the television programs and a lot of the conferences that he sees, that he thinks we will have more assets under management in this business than the $5 billion that he now has in the equity fund within 2 to 3 years. And I can't really argue with that, because that's why I got involved again in this business. I was so excited about the opportunity that it presented. So with that, I leave it open to questions whenever.
We're going to get questions at the end for all the figures, so yep. Thank you, Richard.
Yep.